story to just one name. I actually think it's been actually a pretty healthy thing for the market to, just say notwithstanding. But I think you had a tough week last week, right? And the market kind of in there, like we did okay. And that broadening theme, the idea that the market can be okay with NVIDIA, taking it on the chin a little bit, is actually the first step in something that we think could play out for the rest of this year. The things we got out of NVIDIA's earnings releases, I don't really care about their margin. I don't care about Blackwell's. I don't really care, really frankly, about anything NVIDIA specific with respect to their financial results. The thing I care about is that there are more types of companies in the economy buying stuff from them. More types of companies, there's more sectors of the economy investing in this AI theme and CapEx spending on it, trying to build productivity gaining, productivity producing part into their business. That's going to be the thing that drives the market in the next few years, not really what happens with NVIDIA stock per se. And so that theme came through like loud and clear in the earnings releases, and that's something that we'll be watching for pretty carefully going forward.
Well, here's what comes back to the original question, though, is that the money is going into other ideas related to NVIDIA, but are still tech and AI centric. I mean, Meta, whose chart was pretty decent. Everything else is pretty well off the high, whether it's the hyperscalers that are buying their chips, the other chip makers, which are under pressure. Cloud companies have been really soft. It doesn't seem like there's a lot of big winners in the AI world as far as cloud goes. So that's what comes back to that first point about the stuff that's been strong, staples, utilities, healthcare. I mean, is this not typically like stuff you buy the cycle slowing down, Scott?
Yeah, no, that's a good point. And because the answer to your question is obviously yes. But the other thing we saw towards the end of August was small cap winning, and value winning. And those are the kinds of things that you tend to really buy at the end of an economic cycle. And so, I think actually the framework that we've been using here for a while at Horizon to understand this economy, this market, really isn't a business cycle framework. It's more like a war and a war recovery that we've been through the last 2 or 3 years. Pretty much all the economic indicators have effectively just been horrible and have failed miserably for people that look at them, like inverted yield curve or like all the stuff people look to figure out like what's coming next in the economy hasn't worked for years because we haven't been in a business cycle for years. We've been in a war and a war recovery period that kind of like ended World War II. Now we're coming out of that right now. We're in the process of normalizing, and so I think these leading indicators will start to work again, and in the coming 12 to 18 months. But part of the reason why people have been sort of confused is because there hasn't been a very good playbook that we tend to look at in terms of business cycle analytics and what to invest in and what different parts. So I think that can lead to an August, like you said, where we're getting staples, utilities, healthcare, defensive, plastic, and defensive sectors doing well. Where at the same time, we got small caps also doing well. It's just things that don't really sort of jive internally. But I think that confusion is coming to an end. I think that the healthcare is probably a place we want to be. Small caps is going to start to be interesting towards the end of the year. But you want to keep your foot on the accelerator for tech exposure. It's just not a place to be short. It's not a place to be underinvested. This theme of CapEx spending on AI and the productivity gains we're going to get out of it is pretty real. First time we've had it in generations.
Scott, really good point. I want to rewind it back there for a second to the point about the cycle. I think that's so crucial. Really, really important. Literally wrote about this morning in the newsletter, which is that the market's been positioning in like this early cycle way. The Russell stuff, the value, the more cyclical components, some of the higher kind of data stuff that depends on rates. Those are like the early cycle news, like where you're coming out. The problem is that the economic indicators, somber, uninversion of curve, those are all because the Fed's got to cut to save the economy. Those are all classic, historically supported late in cycle messages. So that's where his thinking is coming from. So that's why seeing the economic data is so crucial because you very well could be right. Like, look at the debt to GDP stuff. That's all World War II, the comps. So then how to determine which side of this kind of data outcome, late cycle or early cycle, is going to win out? I mean, is that why these economic data prints are leading to such volatility right now?
And the short answer is yes. This is an economic growth story, not a inflation story. This is an employment story. Employment and growth are going to be what we're really trying to drive markets here for the next 6-12 months because frankly, it's going to be what drives the Fed for the next 6-12 months. And we think that we are coming out of a place where we have incredibly strong nominal GDP growth. However, we have 8, 9, 10, 11% nominal GDP growth there for a year or two through the middle of COVID. After the big shock, obviously. And we're in the process of normalizing that. So we're coming back down to this 5 or 6% nominal GDP growth figures which is still fine. So, like this is this normalization process out of these really hot times that we had. They don't see it and everything else. It's going to be the end of being a healthy place in the market. But I think like kind of time clock and that process of thinking through things in that framework. But that's obviously a year and a half away.
Okay. So then the question is basically which data points are going to prove out the thesis? Because it's probably the most sound case for why we could potentially continue to have cyclically tied companies doing well, the market holding up, the economy doing well. So look at the unemployment, look at Solomon, when you go under version of the curve, you go 8 out of 8 these things work basically. Smaller sample size, but they have great historical backing. But there's really good logic to what you're saying. So then how do we know if what you're saying is coming true, Scott? Does that mean that the unemployment has to stop going up? Does that mean that basically we have to put a lid on the deterioration in the economy? And does that have to happen like now?
Yes, and I think that's why you saw how so fortunately Jack's called much more fortunately than folks were anticipating in terms of saying that further weakening in the labor market is unwelcome. That sounds great to work. It's unwelcome. Is important. They don't want to see it for the weekend. They know they have to perform this thing. And I think that's why they push the committee for to start with 50 and go pretty aggressively towards 3%.
Okay, so then if you're in stocks, you're wanting yields to go back up, right? You're wanting to see good data here. You're not wanting to have to get a 50 basis point, or is that type of thing that you do want to root for, Scott? We need to have them come in and basically give us like a little bit of a steroid shot.
Well, I don't think we need necessarily a steroid shot. But I think what we need is a little bit of context around why. If they do start with 50, you think that the market reaction is going to be, oh my gosh, what do they know? It's way from we thought. Selling thing. I do think that might be the initial reaction. But you're right. What that starting rate would be, well, it would be pretty important. If it just says, listen, we think we're very restricted right now. We don't need to be restricted because the mandate is in the process of being won, and the employment mandate is more risk, and we just want to get rates back to normal. Like that's all we want to do. We want to get back to normal reasonably quickly, not in a shock manner, but reasonably quickly. And because we have a lot of work to do to get it back to normal. It'll take 2 years. They go with 25 basis points a meeting. We don't need to take 2 years to get rates back to normal again. We just get there a year, and then you can do that by going 50 instead.
Okay. Scott, the final point here is when you, if you expect this, if it does go kind of down according to expectations, do you favor a more specific targeting of sectors and stocks than just an index that still does have a lot of that tech stuff in there? Is that working against you at this point? If you want to play like an early cycle or refresh type of trade here, does that favor being more specific stock-wise or sector-wise and going with the tech-loaded index?
I think you do still want to. You lose one market weight on it. Market weight on here, but you can be underweighted because there's too much dominant team that we're going to have over the next 24 months. And it's right. So we think you got to be at least there. In terms of the other stuff, I think it's hard to be a little bit more specific, a little more choosy, and have the investment. If you want to put money in cyclical things, we think energy is a original place to be. You get some geopolitical hedge. It's not what to find out, and that absolutely is that's one of the banks of growth right now. So that's probably a great place to play. But options are cheap. Champions are frequently cheap. But actually, I think probably a good place to play on the value side. We do use some different small caps, and we do think you want to be start really looking at healthcare as far as one of the early AI winners for drug development and drug type processes that these technologies can really improve. But overall, tech, healthcare, energy, that's probably the place to be.
Okay, great job.
Screen.
Yeah, framework, definitely an encouraging one that really does check all the boxes to explain kind of where we're at. Appreciate Scott Lau, Chairman Chief Investment Officer at Horizon Investments. We come back and we'll have about 60 seconds until the opening bell here. All right, is it early cycle coming out of a war-like event from COVID? Strong case for Scott. Unemployment data this week will be a crucial update to that thesis, of course, and that's why I'm getting markets a little bit nervous because it was the last thing to see that just a few days later sent us to VIX 65. So markets definitely waiting here as September begins.
With Swap investing fees, it's easy to invest in ideas you believe in. Spot a trend in electric vehicles, have a passion for online gaming, or want to explore the space economy. Choose from over 40 themes, each with up to 25 stocks identified by our unique algorithm. Buy it as it is, or customize to align with your goals. All of your fingertips. Schwab investing fees, 40 customizable themes, up to 25 stocks to get the few
Kickstart your morning with full technical analysis, economic data, and live reaction to global markets. Available anytime, anywhere, any device, or and available on all your favorite streaming services. Futures with Ben Lichtenstein every weekday, 8 a.m. Eastern on the Schwab Network.
Neil, that's my favorite client.
Quick question, Carl. Can you offer me the same choices as Schwab?
Choices?
Yeah, at Schwab I can get full service wealth management advice and investment trading on my
Come on, you know Carl's the right choice for me, right? Neil, tell me you know this.
Gotta run, Carl.
Schwab. Have a choice in how you invest with Schwab.
It's time to move forward
Find the next trend.
from every click to every tick.
With no fear of missing out on the next trend.
Available anytime, anywhere, on any device, for free. Empower your portfolio with the Schwab Network. He's out coffee. I'm Jen McCord. Join us for Next Gen Investing.
1 p.m. Eastern, only Schwab.
I'm Nicole Catalidis, host of Trading 360 and The Watch List, live on the floor of the New York Stock Exchange, where we bring you breaking news, experts, CEOs, influencers, and analysts. It's all available on Schwab Network.
Positively positive. All the usual suspects, you know who you are. I'm out of here. Have a great trading day, and I'll see you in the next one.
versus 62 days.
I'm glad you're kind of jumped off the call, Sweetie. On the upside, this is not a shocker here, but you have utilities, consumer staples, and financials as you have a little bit of bid into the bond market. But I gotta say, it doesn't feel like there's a ton of follow through selling from yesterday yet. I appreciate the Nasdaq's off by 0.7%, but it was down 3% yesterday. So let's just see as we kind of head into the opening for today.
Plus the the big one of the big data points that market will be looking at, the Fed will be looking at, will be the labor market on Friday. We have a change, and I'll be here Friday. The change in non-farm payrolls, 165,000 is the number, 143,000 last period. The unemployment rate expected to be about 4.2%. A couple of key joins is because I want to break that down with some of the other economic data from this week. Of course, all the economics, Bloomberg, TV, radio, and pretty much everything else. So, Mike, it feels like this non-farm payroll number is going to be pretty important for the marketplace and for the Federal Reserve as they think about what to do on September 18th.
Yeah, it's going to be kind of.
If they do run it for me, a lot of stories are going to be
about 25 or 50 basis points in terms of the Fed rate on the 18th. The consensus is we return to a little bit of normality, I guess. If you define normality as what's been going on for the last 2-3 years in terms of job creation and unemployment, there's a feeling that maybe we saw some distortions in the July numbers that'll reverse in August. And if that's the case, then the Fed still has the evidence that the economy is doing well, and even though we may not need the rates we have now, we don't need an emergency yet, a big cut. And so there's a hope that they will go on 25, and that'll be the way the market thinks through this.
Is it going to be a Rorschach test, though? Like, see what you make of it? Like, if I already think we're going to get 50 basis points, we're going to get it no matter what the number actually is?
We've been doing that in the market. The markets have been doing that now for years since the Fed started raising rates. Did they do enough? And now cutting rates, are they doing enough? There are people who think that the economy is weakening rapidly, and the Fed should be responding sooner and faster. So that debate's going to go on, but I think the majority of people will price in or retain a price for 25. Now, partly lead into, as will CPI the following week, the question of how much do they do by the end of the year, which is a sort of distinction I really don't because they have another meeting in January and March. But we've seen 100 basis points priced in, which implies 50 at some point. That's only 3 meetings left. So does that change based on what we see?
I'm just looking at the U.S. employees on non-farm payrolls, again, looking for, a positive number of 114,000 last month. It doesn't go negative very often. I mean, something's really got to be bad when you get a negative, kind of non-farm payroll number. It has to be a pandemic, or it has to be the great financial crisis. Before that, it's, the early 80s. Very often. What's a reasonable number for the Fed? What do they like to see across the table?
Well, the idea of just having enough new entrants into the labor force is about 100,000. That's fluctuated over the years based on the size of the population of the labor force. But they would be satisfied with markets with that because it forces the change that the markets want. Stepping down that far would worry people that the economy is slowing too fast. If we go down to that level, then the Fed and the markets would probably be fine with that, accepting it as the way things should be. But we've grown used to this idea of big gains every month and unemployment rate below 5% for so long that it's become sort of normalized.
Yeah.
Speaking of, can I just point out, Dow is still positive at 0.2%. Didn't I call this with you, Michael McKee, on email earlier?
And I have a question for you guys.
Okay.
Because you're both the stock experts. This was
Not true.
Abigail Doolittle. Yeah. All day long, we and others have been saying NVIDIA had the biggest market cap loss ever yesterday.
Yeah.
Does that matter? I mean, market caps always go up and down, though. And the more people buy stocks, the higher indexes go and higher stocks go. So isn't it more important to say the percentage value of a share fell the most or whatever? Because that's what I would own and where I would feel the pain.
Yeah, Yeah, but you know what's not sexy? Is saying in a headline, the percentage value of the share was down for NVIDIA. You know what is sexy? $270 billion market cap loss for NVIDIA.
Yeah, and that's real money. I mean, I don't care who you are.
Well, Bloomberg had a story earlier today that said yesterday NVIDIA lost what they told me.
Oh, I love those
I thought that was a
comparisons.
good comparison.
No, that's
That was a sexy one, as you say, even though it doesn't
mean anything. Yes,
Yeah.
exactly. It's called journalism. Before we get to Friday, though, we get Jolts at 10. So I'm not going to be here because they don't let me do 5 hours of radio. But David thinks you let Paul do that. So what does Paul need to know at 10?
Totally unfair. We're anticipating that we will continue to see job openings decline. We've gotten now down to the vacancy rate, basically unemployment versus the number of jobs out there being at a 1.2% ratio, and that could fall further. And if you get down to about 1%, then you've got as many job openings as there are looking for jobs, and that is what you historically normal situation should be. So that would tell a Fed that the labor market is loosening up some and continuing to loosen up. And again, it's a question of magnitude, not so much should be expected to go down as long as it doesn't drop precipitously.
All right, we don't want that. And real quick, is there an unemployment rate that the Fed is comfortable with, or is there an unemployment rate that you see something on Friday that would spook them, or do they not?
We used to think where we are now, it's way below the national rate of unemployment, and that has changed a lot. We feel we can get down to much lower rates of unemployment now. The Fed would look to anything above maybe 4.5 as worrisome, and also get the magnitude, the speed of the change to that, because they predicted 4.1%, you meant 4.2% by the end of the year. Now we'll get a new forecast in September, but they'd be looking at that. If it goes below that for some reason, that
All right, Michael McKee, thank you so much for joining us. As always, Michael McKee does all the economics for Bloomberg Television and Radio. Appreciate getting some of the thoughts. Go is a really good function that keep you up to date on what all the economic data is coming out and kind of where the street is in terms of consensus, because it moves markets. With our news in New York City.
Thank you very much, Paul and Alex and Lisa. Israel says it can't leave the border region between Gaza and Egypt, known as the Philadelphia Corridor. Hamas has insisted Israeli troops leave the area as part of the ceasefire deal, but Israeli Strategic Affairs Minister Ron Dermer says the security risks are too high.
The fact is, for the last 20 years, since Israel left in the disengagement, a move that was applauded by the whole world, we left that border called the Philadelphia Corridor. We left the border between Egypt and Gaza. We have not had a solution on the ground. I'm not questioning the intentions of the Egyptians. I'm questioning the results. And all of Israel saw it. October 7th could not have happened without that border being open.
Israeli Minister for Strategic Affairs Ron Dermer spoke on Bloomberg surveillance. The presidential debate less than 1 week away, both candidates are working to get out their message. Donald Trump is focusing on the border. Vice President Kamala Harris is focusing on the economy with us out today in New Hampshire. A long-awaited report is out on the Grenfell Tower fire in West London that killed 72 people in 2017. The report lists a catalog of government and industry failures in concluding that all the deaths were avoidable. UK Prime Minister Keir Starmer issued an apology and addressed Parliament this morning.
Mr. Speaker, today is a long-awaited day of truth, but it must now lead to a day of justice. Justice for the victims and the families of Grenfell, but also a moment to reflect on the state of social justice in our country, and a chance for this government of service to turn the page.
Prime Minister Keir Starmer promised to act on the recommendations in the report within 6 months and to take steps to ban companies involved from receiving public contracts. Global news 24 hours a day and whenever you want it. With Bloomberg News Now, I'm Michael Barr. This is Bloomberg. Alex, Paul, and Lisa.
All right, thanks so much, Michael Barr. Appreciate that. So, as I mentioned, stocks are flipping a little bit positive here. The Dow Jones Industrial Average up by 0.3%. The S&P now flat. The Nasdaq down by 0.3%, and volume is also pretty strong. So I wonder if that buy the dip will be something that we will see as it plays throughout the day.
Well, it could be. I mean, I think the the expectations, maybe the market's swimming. You can always make that call here with the stock market up, S&P up, 17, 18%, and maybe it's gotten a little bit ahead of itself. But if you talk to the Gina Martin Adams at Bloomberg Intelligence, she kind of feels like the earnings have been there to support this move in the market, and the expectations remain pretty solid for earnings across the across the kind of the curve there. And so, with the Fed that's about to begin cutting interest rates, one can make the call, a constructive call for higher markets here. So we'll have to see. But looking at the 10-year Treasury, yields coming in 3.81% on the 10-year. But I'm going to call that WTI crude oil below $70 a barrel. I know as someone who fills up the tank once a week, I like that.
No, you like that. I don't know if the financial market's going to like that. A city had a note out that said, look, we might be close to the bottom, but you won't really get a sustained, meaningful bounce unless OPEC Plus actually cuts more. Not add back in oil, but actually cuts more, and that's going to be a little dicey. I don't know. If weakness continues, you may wonder if that's true. Coming up, Andrea Auerbach is Global Head of Private Investments at Cambridge Associates. She'll be joining us. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And benefits from the introduction of steak into its menu earlier this year.
Delicious. All right, we've got breaking news on the Bank of Canada. One of the coolest things about the Bloomberg terminal is for most central banks, you can just type in Fed Go or BOE Go or BOC Go and get the latest on that central bank's decision. So the Bank of Canada is cutting its policy rate now to 4.25%. Take a look at the loonie here and you can see, well, not much movement at all. All right, let's move on from Canada. The Biden-Harris administration's big bet on Intel to lead a U.S. chip-making revolution is in trouble as a result of the company's mounting financial struggles. We discussed with Bloomberg Technology co-host Ed Ludlow, also, I would say, an expert on Intel. You've interviewed Pat Gelsinger on a number of occasions, the CEO. Is he in trouble, Ed? I mean, are they going to be able to carry out Gelsinger's plans and get their hands on this money from the government?
Well, there's a line in the Bloomberg report from last week about Intel's direction to bankers looking at strategic options that Pat Gelsinger's running out of time. But there's frustrations on both sides, right? There's frustrations from Intel, according to our sources, that the CHIPS Act money they secured, $8.5 billion in grants and about $11 billion in loans, is not forthcoming. Intel wants it sooner, they want access to it, but it comes with strings attached, which basically is proof of work on their manufacturing footprint expansion and vetting. And that's the frustration on the administration or the Commerce Department side. They made rules about that access to capital. Intel really needs it, but it's also, per our reporting, pulling back on its ambitions because financially it's under duress. And we seem to be at a pretty tricky spot right now.
And of course, Libby Cantrell from PIMCO was telling us earlier about how unfortunate this is for the Biden administration, just when it comes to timing here. But there's been a bevy of bad news when it comes to Intel. This is from Reuters reporting that Broadcom's tests involving sending silicon wafers through Intel's most advanced manufacturing processes failed, Ed. I mean, how big of a setback is that?
So what Intel will tell you is that they are actively engaged with, say, a dozen customers who would, on paper, take advantage of their manufacturing or foundry business. The cutting-edge process they have currently is called 18A. The Reuters report said they ran a test, they ran silicon wafer through the 18A process, and it failed. And the conclusion, per the Reuters report that Broadcom reached, is that that Intel process is not viable for volume production. The response from an Intel spokesperson in that report was they're still on track for their original timeline. But to join all the stories together, Intel needs the CHIPS Act money to ramp up its foundry operations. It also needs third-party, genuinely and tangibly revenue generating for them to use that to stem its financial losses. At the same time, they're having is going well, and per the reporting of Bloomberg last week, they're having to make tough decisions to scale back, be that separating out the foundry business, or more likely cutting back on existing projects. So how can you go in good faith to the US government and say, we want the CHIPS Act money sooner, but also be sort of looking at your own balance sheet and planning and saying, we're going to have to pull back on our manufacturing expansion because of the realities of our finances?
Ed, we thank you so much for your time and your reporting. That is Bloomberg Technology co-host Ed Ludlow. And coming up, the Nordstrom family makes its pitch to buy back the retailer. We're going to have details for you on that deal next. This is Bloomberg.
Loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
All right, this is the Bloomberg Open Interest. Let's take a look at some specific stocks right now. Of course, we have some earnings reports there. We have Dick's Sporting Goods. We have a Dollar Tree, both down mightily right now. We know it's been a really difficult time for some of those stores, of course, as consumers pull back here. But then, on the other hand, we have Nordstrom, of course, rising right now, up 1.6% right now. Shanali, of course, on some potential M&A news.
And Nordstrom is the focus today of our Wall Street beat. We're going to bring in Bloomberg's Crystal Say, who covers deals, joins us now. And she joins us actually from the Goldman Sachs Annual Retailing Conference in New York. I'm sure this is the talk of the town there. And Crystal, before we ask how you see this process going to spill out some of the facts of the deal. They've retained Moelis & Company. They've said in a statement, or a filing rather, that they are looking for debt financing to complete this deal. And the offer of $23 in cash per share is contingent on that financing as well as a certain amount of shareholder approval here. Of course, this is the founding family of Nordstrom, but $23 is still really the average price of the stock over the last 5 years, and well below the high. How do you think the story plays out, given what we know?
So first of all, it's really interesting to look at the department store space. It really has changed a lot in the past 5 years. They're quoting this, it's a 34% premium compared to their previous whatever period that they looked at. But if you look at department store, a lot of change in e-commerce, a lot of change in the way that people have shopped. So if you look at the 5-year horizon, it really wouldn't be too flattering for Nordstrom or for any department store. And like you said, there is a family component here. I think the most interesting thing about this Nordstrom situation is that the consortium, the Nordstrom family, and this Mexican department store actually only combined 43% of the company already. So they're trying to buy whatever they don't own yet. And like there will be a couple of hurdles, like you said, financing being one of them. But we will see how this plays out.
Well, and a poor outlook, as you point out. I mean, I get that the family wants to buy the asset because it's their namesake. They have a huge history here. But can they make money? What do they need to do to improve operations at Nordstrom? Do they need to invest a lot?
So there are different ways to run a department store, but a lot of people would say the real turn of the century really is that people shop online these days. And but then if you don't shop online, you really value the experience. But whatever you're doing, being privately is what they think is a better option. If you look at Saks, which is a private company, they had actually explored things like spinning off their online business and doing, capturing the online valuation versus the offline brick and mortar store. And that allowed them to do that because they don't have to report quarterly. So this is probably what the Nordstrom family, as you pointed out, the family, the two members behind this deal is actually the great grandson of the founding member of Nordstrom. So it has a family heritage there, but they're also looking at being away from the public eye and being able to transform Nordstrom as a company privately.
Johann Wilhelm Nordstrom, the founder, changed his name then to John W. Nordstrom. Crystal, thank you very much for joining us. Crystal C. there talking to us about this potential M&A action. Coming up in the next hour, Nancy Tangler talks chip stocks. Sharon Bell of Goldman Sachs on Euro versus U.S. stocks. And Raymond James CEO Paul Riley is in the C-suite. This is Bloomberg.
gets down to the 18 to 35-year-old market. How do we bring these kids, these influencers, this new generation of people interested in the game of golf? There's 738 million people in the world who are interested in the game of golf. Don't play the game of golf, but actually there's about 60 million golfers. So we have another 670 odd million people we can go figure out how to get them interested, not just in live, but in the game of golf. And so we sit down and you talk about this internally with your production team, with your marketing people. When you look at our audience base today, that we have like just around 50% of our ticket sales are 45 years and older and younger. Following the PGA Tour, it's the oldest aging demographic in sport, 67 and a half. So in a matter of a year and a half, basically, we've pulled that 67 and a half down to 45 because of our product, because of the entertainment side. There are places around the world where 32% of our ticket sales are women. So they feel inclusive with. Right? So all of a sudden, we're seeing these data points coming out going, oh my gosh, we're owning this.
Really? Still get NDPY, you know. No proprio.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been in U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, good Wednesday morning.
Amigo,
In our
can't
Bloomberg studio in New York City to our worldwide audience. We're also streaming live on YouTube, so you can go to youtube.com, search Bloomberg Podcast, and that's where you will find us. Alex Steele, she's moving on to her TV studios. John Tucker sitting in for Alex for the next couple hours. We've got some economic data. The JOLTS data just came out that weaker than expected, 7.67 million versus 8.1 million. We'll get to that in just a moment. So I'm also going to take a look at NVIDIA. It's stock had a big move yesterday. Lots of issues there, including Department of Justice taking a look at that. So we're going to bring in the best of intelligence. Mandeep Singh, he covers the industry, the stock, and we've also got Justin Teresi. He's Bloomberg Intelligence antitrust litigation analyst. So we've got an expert on antitrust to kind of size up what this means for NVIDIA and for the tech industry. All that's coming up in the next hour. We're also going to check with Michael McKee, get his thoughts on this JOLTS data as well. We've got the jobs number coming up on Friday as well. September 18th is when the Federal Reserve meets next week. All the latest from Michael McKee. But right now, let's go to Melissa Mateo. She is still here in studio.
And going strong. Good morning. Market Drivers brought to you by IBKR with Interactive Brokers Forecast Trader. You can trade your views on key economic and employment indicators. Visit IBKR.com/forecast and get started today. All right, more economic data out. Where do we start? All right, let's start with, going to head over to JOLTS job openings. Experts expecting further decline, and we kind of see it here. So we have the survey was for 8.1 million, came in at 7.67 million. The prior was for 8.18. That was revised to 7.91 million. Then we want to head over to factory orders. The survey was for 4.9%, came in at 5%. The prior was a downfall of 3.3%. And durable goods orders, the forecast 9.9% came in at 9.8%. The prior was for 9.9%. Now, on top of that, we also found out the U.S. trade deficit that widened to a 2-year high in July to $78.8 billion. That was thanks to a surge in import goods. A lot of American businesses stocking up on, as those dock workers consider a walkout. And then finally, the housing front. We had U.S. mortgage rates fell last week to their lowest level since April 2023 to 6.43%. That's a 30-year fixed mortgage. That's according to the MBA. And later this afternoon, we're not done yet. It's the September beige book. So the reaction, we had the NASDAQ down 0.4%, 83 points at 17,052. The Dow up 0.2%, 80 points at 41,017. The S&P 500, little change, down about a point at 5,527. Want to point out quickly, WTI crude, $69.91 a barrel. That is your Bloomberg Business Flash. Paul and John.
That's a lot of stuff there, Lisa. Thanks for getting through all that. Lisa Mateo, thank you. John Tucker sitting in for Alex Dio for the next couple hours on Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. And we want to welcome our listeners in New England on the all-new Bloomberg 92.9, Boston's #1 source for news on the FM dial. Bloomberg 92.9. John, what?
It's a big boy station with a real signal.
Yeah, real signal. That's what I understand. Getting all across the
50,000 flaming watts of business directed at you, Boston.
Exactly.
I don't know how many watts it is, but
absolutely for that. All right, but the Jolt's coming in a little bit weaker than expected. Kind of brings into focus, John. I guess what we're going to see Friday with the payroll.
And raise the question for me: 25 or 50?
Yep, exactly.
So does that reinforce the case for maybe 50 basis point cut from the Fed?
Yeah, that would be interesting. We're going to have Michael McKee in just a few moments. We'll break it down, of course. It's kind of got a mixed screen, as Lisa was just reporting. Kind of some reds, some greens, something for everybody. After yesterday's sell-off, let's look under the hood and see where some stock action is occurring in the marketplace. We do that with Billy Lipschultz, who covers all the equity markets for Bloomberg News. He joins us here in our Bloomberg studio. Billy, what are you looking at?
I know you guys will spend some more time on the Department of Justice subpoenas for NVIDIA, but just want to call out the stock right now, down about 1%. Well, when you take a step back from the last week high, August 27th, the stock's down 17%, $543 billion in market cap. Yeah. So keeping an eye on NVIDIA. Again, modest decline today, down 1.3%, but still accounting for about 4 points in the red for the S&P 500. So the second biggest laggard, when you look at it kind of under the surface, only behind Apple, which is down 2% this morning. Investors really going to keep an eye on that $100 level, which was the low back in earlier last month, again, keeping an eye on that level from the last month's lowest close, but certainly a lot to digest, whether it's AI mania kind of running out of steam or those potential DOJ.
And I'm just looking at Rich Go, Jensen, the founder of NVIDIA, yesterday. It's a bad day.
Well, it's all paper losses.
Yeah,
But
so
it
like
raises the
50
question
here.
for me, what's the attractive entry point? What are you hearing?
People are looking at 100, and that's simply the fact that that is the closing low that we saw last month, or below that was last month's closing or intraday low. The big question is, when do you buy? And so many people are underperforming benchmarks this year. NVIDIA is still up more than 100% year to date. So we're seeing investors who hadn't missed out on the rally putting money to work now, and investors who maybe have been long the stock for the last 6, 9, 12 months riding it on the way up are taking some of their profits and maybe rotating that into safer investments.
Has anything fundamentally changed at NVIDIA?
No, and that's the thing. We're kind of at least what Evercore Wealth Management kind of put it. We're in a vacuum right now. There's now that earnings is in the rear view from last week, you're seeing the stock continue to drift lower. But the big question is, what happens with the Blackwell launch? What happens fundamentally going forward? And that's kind of the, I guess, uncertainty around the Justice Department investigation is how could that impact the company and as investors right-size their books? Maybe that's why you're seeing a bit of selling.
And we're going to have some more detail on that. John Mandeep Singh, Bloomberg Intelligence, he's analyst who covers the stock. Plus, Justin Teresi, Bloomberg Intelligence antitrust litigation analyst, to give us the real feel for what the DOJ is thinking about as it relates to NVIDIA and Dollar Tree.
Bad day. Right now, down 19%. Your ticker DLTR, worst performer in the S&P 500. Second quarter earnings were a whiff. Full year guidance well below what analysts were looking for. Same store sales growth coming in below what analysts were expecting. Really, you're seeing this continue to play out. We saw Dollar General just a few weeks ago kind of sounding the alarm on lower end spending. Well, this is still playing out for Dollar Tree. The stock right now trading at a more than 4.5-year low. Has done nothing really but move down to the right. The company is basically saying that for the outlook for the rest of the year, Dollar Tree, Family Dollar are going to be areas that they're keeping an eye on, but it does not seem good.
Do we use these stocks as bellwethers in any way?
For the lower end consumer, I think that's kind of what we saw a few weeks ago. Target beat expectations, Walmart beat expectations, because your middle and higher class consumer is down spending and going for some of those private label goods. And this is a signal that at least we're kind of at least well off, or its people are struggling.
I mean, well, you mean the stores, the quality of the stores. So you got to get in here.
I'm a fan of deals, but that's the other thing is that when they reported that the dollar spent per visitor is weaker than expected, that's another signal that people aren't buying additional goods maybe.
Again, just get a mop, clean the stores.
Clean the stores. What is Z still?
Cybersecurity play.
You missed on cybersecurity.
Even the quarter, but the guidance is what was weak. And so there's a debate. Bloomberg Intelligence saying, billings growth expectations could prove conservative. Number of analysts on the street saying that the first half outlook actually is just going to be odd. This is a company right now, ticker ZS, down more than 16%. Biggest intraday drop since February. But again, billings seem weird. That's according to Barclays, very oddly shaped year. They kind of are coming out defending it. A number of analysts cutting expectations, but still remaining bullish. It's really all we're seeing. It feels like still kind of shaking out winners and losers in what was such a hot space. And now you're seeing some of these companies trying to deliver on what seemed like overwhelmingly lofty goals. But again, adjusted EPS guidance for 1Q between 62 and 63 cents. Estimates were over 75 cents.
So sharp out that 17%. Like in the movie The Graduate, the future is plastics. I'm telling my kids, I was telling them the future is cybersecurity. I mean, that's never going away. I don't think, particularly with AI, when all these machines are going to get even smarter and people are going to have different ways. So, all right, some good movement there in the marketplace, some ups and downs. Bailey Lipschultz, thanks so much for joining us. Bailey Lipschultz covers the equity markets for Bloomberg News, joining us here in our Bloomberg Interactive Broker Studio. EcoGo, folks, it's been busy here this morning. You see all the economic data that's released by the government. A lot of stuff here, JOLTS, factory orders, durable goods. I mean, I heard about all this stuff in economics class. I didn't really know what it is, but I see the numbers here. Michael McKee, he knows what's going on. He does all the economic stuff for Bloomberg television, radio, and everything else, actually. Michael, what of all the economic data, what jumped out at you today? What do you think the Fed is going to focus on maybe today?
Well, the Fed's going to look at JOLTS because it does show the labor market is in a looser state. We're pretty much back to where we were pre-pandemic in terms of the number of job openings. It was a drop, a bigger drop than expected from last month, but the prior month, June, was revised lower as well. And when you look at what we've seen in the time series, we've seen job openings in the 7 million range for 3 of the last 4 months. So it's not a shock. It's not a major change in the overall outlook. These numbers are not necessarily super reliable. The quits rate, which people take as an evidence of how people feel about the labor market, whether they continue to get jobs, still at 2.3%, where it's been for a long time. So it doesn't look like it's making major news today. Oddly enough,
Change
factory
of
orders
graph
coming
here.
up 5%. Now, durable goods were up as part of that, a revised 9.8% from 9.9%. We knew that. So what that's telling you with a 5% gain after a negative 3.3% for his non-durable goods sales were pretty good. And that is good news for the idea that the Fed doesn't have to immediately cut rates or anything like that. Probably the most interesting number of the day, though, trade balance. Trade balance of $78.8 billion, widest in 2 years, up from 73.0, and just a little bit lower than the forecast, but basically saying that we are importing a lot of stuff. Now, there could be 2 reasons for that. One, the economy is still in good shape and people want to buy, or 2,
Not
people are
opening.
stocking up for the holiday season, which then becomes a question for any retail analysts. Are they making a bad bet or not? Is the economy going slow? Are consumers going to stop spending, and we're going to be stuck with a lot of inventory?
All right.
So
Put that
that's
all
why
in
it's
your-
an interesting number.
Put that in your hand, shake it up. What's the trajectory for the U.S. economy based on what you've seen so far?
Well, it looks like the trajectory is pretty much the same as it was, that the economy has slowed. We're not seeing a fall off a cliff, and therefore the Fed is going to say, we can cut rates, but we don't have to do an emergency rate cut of 50 basis points or anything like that. We can do 25.
All right, Mike McKee, thank you so much for joining us. Really appreciate getting your expertise there on a bunch of economic
USD, hi.
data. Crossing the tape here this morning. Yesterday, NVIDIA suffered a record $279 billion rout as AI worries sink stocks. They also got a DOJ antitrust probe. A lot of headwinds for that stock, a lot of issues for investors to figure out for NVIDIA. Stock's still up over 100% year to date. Mandeep Singh, he's the guy we talk to about NVIDIA all the time. He's Bloomberg Intelligence, he's pretty smart. But the guy we really want to talk to today is Justin Teresi, antitrust litigation policy analyst for Bloomberg Intelligence. I've never met you before.
Likewise,
I
obviously.
didn't hire you, so I'm just going to go on Mandeep's recommendation. What's the DOJ saying here as it relates to NVIDIA? How concerned should NVIDIA and its shareholders be?
Yeah, so I think the real takeaway here, the most important thing to keep in mind, a couple months ago, that DOJ was looking into NVIDIA here. And what we think, there are a couple issues they might be interested in. One, market consolidation. Maybe NVIDIA is growing a little bit faster than the authorities would like to see. The other issue they might be interested in is one related to how they're selling their products. Are they tying things into anti-competitive manner? Are they bundling products in such a way that it's really impossible for other firms to compete? But really, this development yesterday, in terms of the subpoena, really is something we were expecting. And that's because it brings a formality upon this investigation that wasn't there before. Previously, it was an informal question. He's really going to have to certify that the information it's handing over to DOJ is what an accurate depiction of what they want to know about.
Is there a political element to this? I mean, everybody's got
No, they already do.
401k. Just the Harris campaign pick up the phone and say, couldn't you have waited till after November?
I think that might be the question of the day with relation to this. So, look, if I'm NVIDIA's attorneys right now, what I'm trying to do is delay responding to this as much as I possibly can, right? Because there is that element of an election coming up in November here. What does a new administration do with the investigation itself? How hard do they go? Are they more into a settlement than the current regime might be? So that's really the name of the game here. I think you're spot on there that they're really
And the question for Vice President Harris, for me, is: are you going to continue this aggressive antitrust behavior in the administration potentially?
Right. So
it becomes a real campaign issue, doesn't it?
It does, and I think it has. Right. I think we've seen that already with a lot of rhetoric coming from both the Harris camp and the Trump camp, and J.D. Vance on issue too. Right. So I think moving ahead, we think there could be some softening, perhaps, in some ways, or a more measured or deliberate approach to things if Harris were to win the White House. But what we see from the Trump camp is J.D. Vance does have that rather strong anti-big tech mentality when we ever really talk about antitrust with him as a candidate. So really, we're not quite sure what to make of the situation there, but delay is the name of the game if I'm NVIDIA right now.
Indeed, when we talk to investors or we hear from the company, what do investors think about this risk? Is it just another big tech company facing some regulatory headwinds like we've seen for years?
Yeah, I think NVIDIA now is part of that club that Amazon, Google, and Meta, which have faced regulatory scrutiny over the years. And look, in the case of Google, it was fairly obvious that regulators doubled down on their distribution agreements that they had with Apple and Samsung to be the default search. So in this case, it will be interesting to see DOJ's approach. What is it that they really want to focus on in terms of how NVIDIA is distributing their chips to the hyperscalers and their largest customers? Because clearly NVIDIA has a lot of interest from all types of customers. The market is undersupplied. So do they have an algorithm to say, okay, I'm going to distribute X number of chips to customer A and Y to customer B? And look, it comes down to NVIDIA's how they have their relationship with their customers, and they can distribute the chips they want.
It seems like it's a market operating efficient, but what do I know? But what I do know is the beauty of Bloomberg Intelligence is we bring together industry and company-specific research analysis, and Mandeep Singh has been doing it for years, and Justin Teresi, antitrust litigation policy analyst at Bloomberg Intelligence. We can bring these folks together. They can partner their research and integrate their research and give you a really good view of what it means for some of these companies as they face some of this risk from the regulators.
it's great to have that as part of the BI Go on the terminal. Oh, guess what?
NVIDIA shares seem to have bottomed out today.
Exactly. Mandeep Singh, Senior Tech Analyst, Justin Tracy, and Trust Analyst for Intelligence in our studio.
So,
Breaking it
couple
down
day,
for NVIDIA. It certainly cost the stock yesterday. Some serious close. That's not interesting.
on it.
With the advance in technology, Papua Guineans have ventured into trading online. However, many have fallen prey and lost out with Kina to scammers. Peter Kinja from PNG Trader said that this is because many lack the knowledge in understanding the retail market in this lucrative industry.
Headlines and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. The Bloomberg Business
The Bloomberg Interactive Broker Studio, I'm Elizabeth Mateo. We've got red and green on the screen. This is after U.S. job openings fell in July to the lowest since the start of 2021, and layoffs rose. So right now we have the NASDAQ down 0.4%, 73 points. The Dow up 0.2%, 99 points. The S&P 500 little change, down about 2 points. We have the 2-year yield at 3.78. 9%. That's down 7 basis points. A yield on the 10-year 3.79%, and that's down 3 basis points. The sell-off in NVIDIA shares, it continues. The stock down about 1%, and this number share dropped 9.5% yesterday, wiping $279 billion off its value. Sources say the DOJ sent subpoenas to NVIDIA, other companies. It's looking for evidence that it violated antitrust laws. Andy Singh covers tech for Bloomberg Intelligence.
Right now, the question that they are looking at is how has NVIDIA allocated their chips in a market that everyone knows is undersupplied? There is more demand for NVIDIA chips than they can supply. So how have they allocated it?
So that trickle-down effect of the news being felt in the chip sector. We have Intel, who is also struggling with growing financial issues. They're down about 1.5%. Chip equipment maker Applied Materials down nearly 1.5%. Even those big tech companies looking to reshape the economy with AI, they're being affected. You have Microsoft down about 0.5%, Apple down about 2%. Crypto-related stocks falling after Bitcoin touched a 1-month low. Bitcoin now down about 3% at 56,000. You have Coinbase down about 2%. CleanSpark down nearly 1%. Marathon Digital down nearly 1%. That is your Bloomberg Business Flash. All right, Jeff.
All right, Lisa Mateo, thank you so much. We appreciate that. John Tucker sitting in for Alex Steele and Paul Sweeney live here on streaming live on YouTube as well. Send it over there. So the podcast and welcome our listeners in New England on the all-new Bloomberg 92.9, Boston's #1 source for news on the FM dial. Bloomberg 92.9. Boston. Let's go to our next guest, Paul Carter. He's co-founder joining us from Boston. Paul, what are you telling your clients these days as to where the best opportunities are? We've got the S&P 500, up 18%. I mean, that's pretty darn solid, but yet I can still get a decent yield into your treasury at 3.8%. What are you telling your clients these days?
Paul, John, thanks for having me.
Só o capítulo já ganhou, né? Pelo barulho igual.
With this most recent number, for today, for the Georgia just came out, the Fed funds are pricing 100% probability that the fund is in September and December.
We've seen that Fed funds market respond with perhaps a greater chance of perhaps 50 basis points at this next meeting. Given all of this, as mentioned, we've been focusing on the Fed funds market. We haven't been perhaps a greater chance of perhaps 50 basis points cut. Given all of this, as mentioned, we've been focused on the initiative. We have been able to take advantage of the run of risk assets, but we're looking to diversify our risks more broadly and away from just purely AI trading as well.
All right, Paul and Paul, I think this is one of those moments where I mean, Paul, you can tell me that the yield curve is inverted.
Oh, wow.
So 2s and 10s.
What's your significance of this, do you think?
A recession is not we absolutely focused on the yield curve. There's perhaps a number of reasons why we didn't see a recession. In part being this whole AI the productivity that we've seen in the economy, the forecasted productivity that we will see from AI. That combined with a lot of the stimulus that is still going in effect after COVID. That said, recession, I think, at some point, is not completely off the table. Hopefully we're able to escape with just a soft landing. But we're 19 years into the business cycle here, so it wouldn't be surprising to see something at some point. Rate cuts become obviously more prominent with some weakness in inflation.
170 traders received $1,000 extra each. Why? Because we processed.
Until then, the market's going to try to decide on the global direction. I think we're just going to continue to sell volatility between.
Paul, in terms of maybe trying to temper some of that volatility, how are you guys approaching the fixed income markets? I'm content to sit in the 2-year treasury 3.8%, but some people might want to take some more credit risk. How do you think about fixed income opportunities today?
Sure. So let's talk about credit.
Bell did perhaps a bit of an overweight towards a short end of curve. So when rates were up 4 to 5, we were taking advantage of locking some money. While it's relative to 3.5% short-term treasury, you have some reinvestment risk if you see rates come down. So we have been starting to nibble at some duration. On the credit side, we've been less enamored with this whole private credit trade that everybody seems to fall in love with. And so we've been focused on more idiosyncratic return streams. On the credit side, seems to be more capacity constrained. And they're harder to find today, for sure. So there's a lot of money that chasing various trades.
So you see a softening in private equity. I think in your investment note, you quote the great Roberto Duran. No mas.
No mas. Yeah,
if we get some a negative surprise on employment numbers on Friday, I expect that we'll likely be at peak fairly quickly within just a couple of trading sessions.
Which is good to surface fine. But we think going forward, the market is completely changed. There's just an enormous amount of market participants. There's just an enormous amount of capital chasing. And we found more compelling returns in public markets, which I would have never thought I'd say that 5 years ago. But that's what
No.
Hey, Paul, thanks so much for joining us. Really appreciate getting a few minutes of your time. Paul Carter, he's co-founder and managing partner at Twin Focus up there in Boston. If you're listening to us in Boston, our new home is now 92.9 FM in Boston. All right, one of the great stocks that was happening here is just X, and that's for U.S. Steel. It's a great stock symbol. But U.S. Steel's in the news here. I mean, I thought Nippon was going to buy U.S. Steel, but apparently there's some risk there. And U.S. Steel comes out today and warns that thousands of jobs at risk without Nippon Steel deal. So I don't know what's going on. Richard Bork does. He covers all this stuff for Bloomberg Intelligence. Richard, give us the status or the update, the status of this potential deal with U.S. Steel and Nippon. Where are we today?
Okay, so we're waiting for regulatory approval from CFIUS, which is the Committee of Foreign Investment in the U.S. That's kind of hold up. But there's been almost every politician in Pennsylvania, Ohio, the presidential election has come out against it because Pennsylvania, as many people know, is a huge swing state. It was decided by 10,000 votes in the last presidential election. And they're courting approval. So there's been a lot of press against the deal. And I think today U.S. Steel just came out and said it's time to face reality and cold, hard academic facts that U.S. Steel doesn't have the dollars to invest in some facilities. It does. And if you kind of just look at credit rating, U.S. Steel is high yield, we double B. Nippon Steel is triple B. So they have more financial worth. These assets.
What's the fear? Nippon Steel's going to come in with giant helicopters and lift all these plants and take them to Japan? I mean, there's a jingoistic element that clouds some of the facts, one would think.
I think what it is there's a lot of it's really into problems between union and non-union facilities. And not only really at U.S. Steel, but they're afraid Nippon Steel will carry on the same tactics. For example, at Mon Valley, back in May of 2019, U.S. Steel came out and said we're going to invest $1.2 billion to upgrade Mon Valley.
Mon Valley is a steel manufacturer.
Mon Valley is a mill outside Pittsburgh.
Okay.
And Union. Yeah. And old. And this was supposed to invest. But later that year in October, U.S. Steel announced that they were going to buy Big River Steel in Arkansas, brand new mini mill, electric arc furnace mini mill, newer technology, cleaner, more sustainable, and but a non-union facility. Then they later that year they announced they were idling Great Lakes, which was a former mill, union mill in Michigan. And then in December they acquired the rest of
big rich deal. At first, they only bought the first 50%, and they bought the second 50%. Then, April of 2021, they announced that they're no longer investing $1 billion in that. So, it's kind of like bad blood between the union and U.S. Steel management, and U.S. Steel, our union is afraid that will carry on kind of the same tactics.
Do you think? How much does U.S. Steel need this Nippon deal to kind of keep going as a viable concern? Is there that kind of risk here? Does U.S. Steel really need to be acquired by Nippon?
I don't think it outlined a plan to how they were going to transfer, called bigger, better bets. That they were going to transform the company over there, and part of it is shuffling away from blast furnaces towards electrical furnaces, which also is shuffling away from union facilities towards non-union facilities. Really, with U.S. Steel, this deal kind of took the execution risk off the table for shareholders. Like, okay, I don't have to wait to see if this plan will be successful, but they do need, the times are changing. There's more premium for clear, sustainable steel, and they need to do this to compete going forward.
What's the market right now? Is there too much steel out there?
Well, the U.S. is kind of a funny market because U.S. has historically, we need 100 million tons of steel a year, but we only make 80 million of it, and we import 20. I mean, this has been probably for the last 20, 30 years. But the blast furnaces, which are predominant, make higher quality steel, but they're also bigger and more. It's a kind of a scale job. It's kind of the situation where you got to have scale. So in times of volatility, it's a lot harder on the results.
Right.
And that's kind of where we're at.
All right, we see that U.S. Steel, they warned that thousands of jobs at risk without Nippon Steel. Another headliner calls it for terminal U.S. Steel employees to rally in support of Nippon Steel transaction. So we'll see how this plays out. Richard Bork, senior analyst who covers all the basic materials for Bloomberg Intelligence, joining us here. Bloomberg in our Good Broker studio in New York City. Shares of U.S. Steel, $36.82. The stock is higher today on the news. Year to date, that stock is down 24% year to date. So we'll see how that plays out. This is Bloomberg.
Must be to strong United, okay, GPP is United. Cut down angkat hinay angkat strong strong angkat UD apa kok UD kan UD strong USD Oh, per hour, right? Ah, so here. Per hour, oh, 15 minutes. 1 hour. Ang card ni strong na yan. Card versus sa'yo is, yan, naubos na yun. It's not, then you use the card strong. Yung, ano?
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
The previous deal.
From the Bloomberg Interactive Broker Studio, I'm Luis Mateo. Stocks rise, Treasury yields fall. The data showing a further slowdown in the U.S. labor market. And look at Wall Street's bets on Federal Reserve rate cuts. So now we have the Nasdaq up about 1/10%, 20 points. We have the Dow up 0.3%, 129 points. The S&P 500 up 0.2%, or 11 points. The two-year yield is 3.78%. That's down 7 basis points. The yield on the 10-year is 3.78%, and that's down 4 basis points. To commodities, we have spot gold higher, $2,497 an ounce. We have Brent crude, $72.86, $72 a barrel. WTI crude, $69 a barrel. U.S. Steel CEO speaking out. He's saying the company would close steel mills, likely move its headquarters out of Pittsburgh if that planned sale to Nippon Steel collapses. Bloomberg's pretty good to his reaction.
That's actually being well received by the market. It kind of looks like it's almost being interpreted as an efficiency story that it may actually help the numbers there.
Yeah, so now you see you have U.S. Steel shares up about 3%. To earnings, we go Dollar Tree shares. They fell the most in more than a decade. The chain lowered its full-year guidance as its higher-income customers pulled back on spending. Dollar Tree down 19%. And then Dick's Sporting Goods. Well, it beat Wall Street's profit and revenue estimates. Its full-year profit could miss expectations, and that has shares lower, down about 7%. And sticking with retail, the Nordstrom family had offered to buy Nordstrom for $23 a share in cash. Plans to take the retailer private for $3.8 billion. That's according to a filing. Nordstrom down about 0.3%. And finally, Uber kicked off its first bond sale as an investment-grade company. Sources say it's looking to sell bonds in as many as 3 parts. Uber up about 0.7%. That is your Bloomberg Business Flash. Colin John.
All right, Lisa Mateo, thank you so much. We appreciate that. John Tucker sitting in for Alex Steele. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube. We're also in your dashboard, Apple CarPlay, Android Auto. get us anywhere you stream doing all kind of good stuff here. Let's talk a little commodities here. When John Tucker and I talk commodities, we talk the daily national average gasoline price, $3.31. I got a much better deal versus short Sunday.
It's under $3 a gallon.
Is it?
Yeah.
All right, good stuff there. And I guess one of the drivers there is crude oil, WTI crude oil. We were under $70 a barrel a little bit earlier this morning. We're now at $70.45. Mike McGlone does all the commodity stuff. He's the senior commodity strategist for Bloomberg Intelligence from that commodity capital known as Miami Beach, Florida. Mike, what's going on with WTI crude oil? Again, John Tucker and I, we're happy to see this thing go south, but what's driving it?
Well, it's going lower, and I think you mentioned the national average gasoline price. It's going to 286. I wrote about that about 3 months ago. That's the price, the average price for the last 20 years. It's probably just a matter of time. The bottom line for crude oil is the high price cure is kicking in. It went up too much. It's incentivized plenty of supply and plunge in demand. And now you can narrow that down to the exact areas. Well, that's concentrated. The bottom line is most of it's coming from the U.S. and Canada, excess supply, and declining demand from China. And we heard today OPEC's trying to curtail. They've been cutting back production for a while, but it's just a matter of time that comes back on. But crude oil is doing what it naturally does, almost always does. It's the most autocorrelated commodity, and I think it's just a matter of time it gets to 40. Now, most people have heard me say this on the show for at least 2 years. Yes, I have been early. If I was a trader, I would have been stopped out. But natural gas has already done it. Corn's already done it. And basically, it's the number one rule of commodities. You always basically have to get your cost of production. And the U.S.,